Muted.
Pittsburgh Labor and Employment Group Lunch and Learn session. Today's presentation focuses on the PPP, the Paycheck Protection Program, and we're pleased to already have over 150 participants in this call. Today we have two speakers, Attorney Albert Lee, who is co-chair of the firm's Labor and Employment Group and has focused his practice in that field for nearly 30 years. He is well known as a speaker and presenter in the employment law field and as an adjunct professor and lecturer at 6 universities. Attorney Chris Volz has a wide-ranging practice helping private companies and local governments navigate the complex environment of federal and state regulation. He has already authored nearly a dozen articles dealing with the legal issues arising from the COVID-19 pandemic, which can be found on our firm's website, tuckerlaw.com. Before we get started, I would like to go over a few items. All of your phones have been muted. You might want to double check to make sure that your phones are muted on your end as well. A handout for today's presentation has also been emailed to all participants, so you might want to open your emails and follow along with that. It might be helpful. You will have an opportunity to submit and text questions to today's presenters by sending your questions to Allison Hurley at, let me go over the email address, ahurley@tuckerlaw.com. That's AHURLEY @tuckerlaw, one word, .com. You may send in your questions at any time during the presentation. We'll collect those and address them during the Q&A session at the end of today's presentation, time permitting. Today's webinar is being recorded and you will receive a follow-up email within 24 to 48 hours with a link to listen to the recording. And so at this time, I'll turn over the presentation to Attorney Albert Lee.
Thanks, Bob, for the introduction, and thanks to all of you for joining us today. First and foremost, along with my colleague and everyone at Tucker Ahrensberg, I hope all of you and your families are safe and doing well during these crazy times. Speaking of crazy, if you're on this call, the PPP Paycheck Protection Program needs no introduction, nor does its many faces. This law has many faces. On the one hand, it's very likely the best loan program you and your business will ever see. Very low interest rates, fully federally guaranteed, no recourse to the borrower, quick approval, no collateral, minimal documentation, relaxed SBA standards that allow businesses in certain industries of certain sizes or revenue levels to have access to SBA loans that they normally would not, deferred payments, and if that weren't enough, the cherry on the sundae is possible forgiveness. If you dot your I's and cross your T's, a lot of the things we'll be talking about today, this is a loan that gets even better because it may not end up being a loan. It could turn into effectively a grant. Now, on the other hand, the other face that this law has presented, this program has presented, is that this law is very, very restrictive. It's in some ways one of the most restrictive loans you'll ever see. And some of the restrictions are strange and odd and not typical. So under the CARES Act, as it was originally enacted back on March 27th, you can only spend the PPP loan proceeds on certain things, very specific costs. They're actually delineated in the Act itself. There's been a lot of guidance and follow-ups since then, trying to clarify exactly what falls into the buckets and what doesn't. And you can only spend it within a certain time period. The law set forth an 8-week spending period in effect, so that the things that you're allowed to spend it on, you're allowed to spend it on for 8 weeks. And one of the frustrations and challenges, not surprisingly, given that this was a big law passed to do big things in a very short amount of time, to address a situation that's unprecedented, the goalposts have moved. The law, like I said, was passed on March 27th. There was guidance right before people were permitted to start applying for it on April 3rd. We've had dozens and dozens of Q&As several rules have been issued, regulations that talk about all the different aspects of this. So that's certainly been challenging. So today's program, we're going to do three different things. First, we're going to update you on some potential breaking news. My colleague Chris Volz is going to talk about the Payroll Protection Flexibility Act. That's happening in real time here, and that's kind of exciting. That could change some of the things that people have been concerned about. After Chris is done, we're going to discuss what we feel are the 4 key PPP-related questions. One of the struggles when you're dealing with an 880-page law in the CARES Act and a very complex loan program that's changed is trying to figure out how to structure it in your brain, how to get your brain around it. So we've divided what we think into what we think are the 4 key pieces of it. So number 1, how do you best defend applying for, getting, and keeping the money if that's an issue you're concerned about? Number 2, how do you make sure you are properly spending the PPP loan money in terms of what you're spending it on and when you're spending it? Number 3, how do you maximize forgiveness for the amount that you've spent? And number 4, what documentation information do you have to keep, retain, submit to be able to show that you're entitled to the forgiveness you're seeking, or in the event you get a question from the SBA about your application, your eligibility, your entitlement, and your use of the loan money. And as Bob said, when we're done with these pieces of it, we're going to answer some questions from all of you that you are welcome to submit as the program rolls forward. So I'm going to interrupt with an important disclaimer. Of course, this program is for general informational purposes. This content neither constitutes nor substitutes for legal or other professional advice that takes into account you and your organization's specific circumstances, legal jurisdictions, or regulatory concerns. With that all out of the way, I will now hand it off to my colleague, Chris Volz, for the possible breaking news I mentioned earlier. Chris?
Thank you, Albert. And as Albert referred to, as business owners and their advisors who receive program loans on the focus on the loan forgiveness application and related guidance issued by the SBA, and as Albert and I were preparing a presentation on these topics, Congress went and passed an act that makes significant changes to the program. The House of Representatives passed the Paycheck Protection Flexibility Act of 2020 on May 28th, and on June 3rd, the Senate unanimously passed the act by a voice vote without amendment and sent it to the President's desk for signature. If signed by President Trump, the act will do several things. One of the main keys is that it will extend the program and give borrowers a longer period of time to spend the loan proceeds. As originally drafted, the program was set to expire on June 30th, 2020. The act extends the program to December 31st by amending the definition of covered period set forth in the Small Business Act. This change will, among other things, permit business owners to apply for loans after June 30th and allow borrowers to use the proceeds over a longer period of time. In addition, the Act extends the covered period with respect to loan forgiveness. Currently, all permitted expenses must be incurred or spent within the 8 weeks of receiving the loan proceeds if the borrower intends to seek forgiveness. Under the Act, the covered period for forgiveness purposes would end on the earlier of 24 weeks after the date of origination or December 31st. As with the other amendment, these changes will allow borrowers to spend the money over an extended period of time and still seek forgiveness. Now, for borrowers who have already received their loans and are comfortable with making all of their payments and expenses within the existing 8-week period, the Act allows those borrowers to keep the existing 8-week period. Another big change that the Act will bring about is that it will extend the rehiring and wage restoration deadline to December 31st, 2020. The CARES Act generally provides currently that the amount of forgiveness will not be reduced if borrowers by June 30th rehire employees who are let go or reverse salary cuts of greater than 25%. Under the Act, the new restoration deadline is December 31st. In addition, the amount of loan forgiveness will not be reduced due to a reduction in the number of full-time employees, equivalent employees, if the borrower is unable to rehire a former employee or can demonstrate an inability to hire similarly qualified employees on or before December 31st. Finally, the Act will not require reduction in forgiveness amounts due to the reduction of employees if the borrower can demonstrate that this decrease is due to compliance with various guidance or requirements issued by federal agencies relating to maintaining standards for sanitation, social distancing, or other worker or customer safety requirements related to COVID-19. So these are some other benefits that should help many small businesses. Another huge change is that the Act eliminates restrictions limiting non-payroll expenses to 25% of loan proceeds. In early April, the SBA issued rules requiring that 75% of loan proceeds must be used for payroll expenses. Under the Act, that number is reduced to 60%. In other words, a borrower must use at least 60% of the covered loan amount for payroll costs and may use up to 40% of such amount for permitted mortgage interest, rent, or utility payments. There are some other minor changes. Those are the big ones. There are some other minor changes that aren't directly related to our topic today, but should be known. The restriction that loans be limited to terms of 2 years has been changed for future loans. The new minimum term is 5 years and the maximum maturity is 10 years. For existing loans, the Act authorizes lenders and borrowers to renegotiate the term to fit within this requirement. Another important change is that the deferral period has been extended until there has been a forgiveness determination. Currently, lenders have provided 6 months of deferment relief. The Act would eliminate this 6-month deferral period and replace it with a deferral period until the date on which the amount of the loan forgiveness is remitted to the lender. In addition, if a borrower doesn't apply for forgiveness, they will be given 10 months after the program expires on December 31st to start making payments. And the final change is a change to the CARES Act. It's a change to the CARES Act related to payroll tax deferments. The CARES Act permitted employers to forego timely payments of their employee portions of employment taxes. However, an exception was made for taxpayers who had their payroll protection program loans forgiven. The Act eliminates this exception, so all payroll tax deferment would be deferred until December 31st, 2020. So, as noted above, this Act is pending and has not yet become law. However, it's looking like there's a very good chance that it will be signed and enacted. Accordingly, as we move forward, where appropriate, we've noted how this Act would change our guidance and provide you with other important information. So with that, I will turn it back to Albert, who will work on topic number 1.
Great, Chris. Thanks so much. Again, we are going to talk about the PPP in 4 distinct topics. Number 1, how to defend applying for, getting, and keeping the money. Number 2, how do you make sure you're spending the money right. Number 3, how do you make sure your maximum forgiveness of the money you spent is achieved. And number 4, how do you make sure you keep the right documentation. We have, over these 4 different topics, we've set up 12 do's and don'ts. If you want to follow along, find the handout that we had emailed that Bob had mentioned. If you scroll down to the bottom of that handout, you'll see the 4 sections and the 12 do's and don'ts that we don't have to write them down as we talk. And you'll also note that at the top of the handout, the first part of the handout is an article that Chris wrote that talked about a lot of the new changes that we expect to come into play once President Trump signs the Paycheck Protection Flexibility Act. So I'll kick off with the first of the 4 topics. This is a topic that has gone 2 directions depending on whether you're what's called a big borrower or a little borrower. This is, how do I defend? How do I justify having applied for, gotten, kept, and not given back this money? Now, the distinction between a big borrower and a small borrower is the $2 million level. And this is a very fluid situation that has changed a lot. So here's the issue, is when you got your loan, one of these certifications you had to make, as you may recall, to get the loan, is you had to certify that there was a need for this loan. So the exact language from the law was that you were certifying in good faith that current economic uncertainty makes this loan request necessary to support the ongoing operations of the applicant. So the key 2 words in there are uncertainty and necessary. And that was pretty much it. That language was what was in the law. It was what was in your loan application. And I think most borrowers felt at the time, remember this was back in March and April when the crisis had just erupted. We were dealing with closure orders. A lot of things were unfolding. I think most borrowers felt very justified to cite uncertainty and the need for a loan that could turn into a grant to support the ongoing operations of the applicant. Within a couple weeks, a lot of bad press hit the air. The Ruths Chris's, the Shake Shacks, and the LA Lakers made the government, both the SBA and the Department of Treasury, come out and say, wait a minute, we're going to make sure people understand we're going to be picky, particularly for large borrowers who have other sources of liquidity or other credit facilities. We're going to be very picky to make sure they understand that that was not just a throwaway certification. So we started really drilling in on this certification, and there were some FAQs and so forth. If you look at that handout that we have, we've given some links to our website. There's a lot of information, past articles that we've written about these topics. But the issue when it comes to your certification is really uncertainty and the necessity of it, which some people have lumped together as your need for this one. So with respect to this, a big day was May 13th. If you were a small borrower under $2 million, on May 13th, the SBA issued an FAQ and later a rule that says, basically, if you borrow under $2 million, you're deemed to have made that certification in good faith. That's it. Wipes the slate clean. In effect, a get-out-of-jail-free card, but only with respect to that certification. The SBA certainly can and is expected to look at smaller borrowers with respect to all the other aspects of the loan. So if you are in the small minority of borrowers that are big borrowers over $2 million, we have 2 bits of advice. So in terms of being prepared for what has been called an inevitable review of your loan, if you're over $2 million, we want you to, A, realize the importance of 2 dates. These certifications are state of minds that you're going to have to back up. And they're essentially states of minds on 2 different days. The day you applied, so if you're one of the earlier borrowers, call it April 3rd or April 6th, and May 18th, which is the last deadline that the government gave for you to give the money back and kind of put it back on the table, no questions asked. So if you applied for it in early April and you did not give it back by mid-May. Eventually, if you're a big borrower and you're questioning about your need, so the necessity and the uncertainty, I think it's critical to be prepared to focus on your states of mind as a business on those 2 dates. So that's a do. Here's a don't. Don't rely on general and broad discussions about uncertainty. Early on, when everybody was in the mix, I heard from a lot of clients, a lot of people I talked to, this almost kind of hand-waving type of argument. Well, of course we have uncertainty. This is probably the least certain times in my entire business career. Nobody knows if this is going to last 30 days, 30 months, years. Nobody knows what's going to happen to these businesses. In general, the stock market is plunging. Banks are not lending. All these kind of broader discussions were certainly appropriate to have kind of as water cooler discussions. But for the limited purpose of being a big borrower and preparing yourself for this discussion about need, please focus on very granular things having to do with your business. You're going to win this argument only if you can point to specific aspects of your business, your line of business, your climate, your specific financial circumstances. Particularly focus on things like access to liquidity, access to capital, things of that sort. So the Q&As talk about some language that are guidelines, rough guidelines, in terms of what will matter. So current business activity, ability to access other sources of liquidity, and whether these are sufficient to support ongoing operations in a manner that is not significantly detrimental to business. So I'm reading from what's called FAQ 31. FAQ 31, the SBA, if you Google PPP SBA FAQs, you'll get taken to a page which I believe now is up to 48 or so FAQs. If you find 31, you'll see this language in here, which really is, I think, the critical language. So do focus on granular things having to do with your specific business, the uncertainty, the need, the necessity, particularly when it comes to the day you applied and signed on top of that certification, and May 18th when you didn't get the money back. But those, to me, are kind of the key issues when it comes to the defense of the application, the certification you made as part of that process, getting and keeping the money. So again, that doesn't apply to most borrowers. Most borrowers, if you're under $2 million, which based on the statistics I've read is about 99%. Our borrowers, most borrowers got some very good news on the need, necessity, uncertainty issue on May 13th. You can put that to bed and worry about the other certifications you made, how you're spending the money, whether you're dotting the I's and T's on your forgiveness application and keeping the right documents. So with that, we'll move to question 2, which is how do we make sure we're properly spending the PPP loan money that you do have? And I'm going to have Chris answer that question for you.
All right, thank you very much, Albert. Yes, moving on to topic number 2. The CARES Act provides that, subject to several important limitations, borrowers shall be eligible for forgiveness of their program loan in an amount equal to the sum of the permitted costs incurred and payments made during the covered period. So the first question then, what are the permitted costs? Which brings us to our first do. Do use your loan proceeds for payroll costs, interest payments on existing mortgage obligations, rent payments on existing leases, and utility payments on existing service agreements. The CARES Act permits forgiveness on the following. So we spoke about payroll costs is the first one. With respect to interest payments on business mortgage obligations on real or personal property, they must be incurred on or before February 15th. For rent, the rent lease agreement must be in effect on or before February 15th. And the same with utilities, which applies to the distribution of electricity, gas, water, transportation, telephone, or internet access, for which service began on or before February 15th. So the SBA has essentially broken these permitted costs into two categories, which will become critically important later on, but they are payroll costs and non-payroll costs. So the first one, since it's a category of its own, are what counts as a payroll cost. The statute and the regulations define that. It includes compensation to employees who live in the United States in the form of salary, wages, commissions, or similar compensation. It also includes cash tips or the equivalent. It includes payment for vacation, parental, family, medical, or sick leave. It includes an allowance for separation or dismissal, payment for the provision of employee benefits consisting of group healthcare coverage, including insurance premiums, and retirement benefits. It includes the payment of state and local taxes assessed on compensation of employees. And if you're an independent contractor or sole proprietor, it includes wages, commissions, incomes, or net earnings from self-employment. The statute and regulations also provide some guidance as to what does not qualify as a payroll cost. Compensation to an employee who does not reside in the United States is not permitted to count as a payroll cost. Any compensation of an individual employee in excess of an annual salary of $100,000 or raises necessary can't be counted toward a forgivable payroll cost. An interesting one is the exclusion of federal employment taxes imposed or withheld between February 15th and June 30th of 2020. And we'll discuss that one later, but be aware that it's there. And then finally, qualified sick and family leave wages where the employer received credit under the Family First Coronavirus Response Act does not count as a forgivable payroll cost. So while the statute and the regulations provide an outline of what is permitted and what is not permitted, still plenty of gray area. And since the release of the first regs in the Act, the SBA has provided some clarification. The first clarification is that all benefits of monetary value, other than cash consideration in excess of $100,000, count as payroll costs. As noted above, the CARES Act excludes compensation in excess of an annual salary of $100,000 from the definition of payroll costs. However, questions remained about what about other benefits that have monetary value? In one of its frequently asked questions, the SBA confirmed that the $100,000 cap only applies to cash consideration. It does not apply to employer contributions to defined benefit or defined contribution retirement plans. It does not apply to payment for the provision of employee benefits consisting of group healthcare coverage and insurance premiums. And it does not apply to the payment of state or local taxes assessed on compensation of employees. So accordingly, if you have an employee that makes $90,000 in annual salary and the employer provides retirement benefits and health care benefits that, when combined with the salary, would amount to consideration over $100,000, all of those costs would count as forgivable payroll costs. Another, given the situation of the COVID-19 pandemic, is that several employers had to let some employees go. And on the other end of the spectrum, they had to incentivize some employees to stay by offering them hazard pay or bonuses. So the question was, are salary, wages, or commissions paid to furloughed employees, or are bonuses or hazard pay paid during the covered period to employees eligible for loan forgiveness? We have a solid answer on that, yes, and the answer is yes. The CARES Act defines the term payroll cost broadly, and the SBA has determined that if a borrower pays a furloughed employee their salary, wages, or commissions during the covered period, those payments are eligible for forgiveness as long as they don't exceed the $100,000 threshold as prorated over the covered period. Similarly, if an employee's total compensation doesn't exceed $100,000 on an annual basis, an employee's hazard pay and bonuses are eligible for forgiveness because they are simply a supplement to salary or wages. So that is a helpful clarification for businesses that let employees go and gave them some severance, and also those who had to incentivize them to keep working or come back. Now, they also clarified that payments made to independent contractors do not count as a forgivable payroll cost. Several employers rely on independent contractors to perform services. The SBA has confirmed that because independent contractors can seek their own relief under the Paycheck Protection Program, they do not count as employees, and payments to them do not count as a permitted payroll cost. As for non-payroll costs, questions arose whether you could use the loan proceeds to prepay your mortgage or even make principal payments on a mortgage. The SBA has come down very clearly and said that the proceeds cannot be used for these purposes. The CARES Act loan forgiveness provisions specifically exclude prepayments, and principal on mortgage is not eligible under any circumstances. So, as set forth above, the SBA has issued clarification as to what you may use your loan proceeds on and receive forgiveness for. Certainly some gray areas remain, but hopefully this will assist you in determining what is a permitted cost and what can and will be forgiven. So that's our first do, know what you're allowed to spend your money on. The second one is our first don't, and that is don't use more than 25%, which will potentially be 40% of the proceeds from the loan on non-payroll costs. As we noted above, the SBA has identified two categories of permitted costs, payroll and non-payroll. The CARES Act, as originally enacted, did not restrict a borrower's ability to spend their money on any of the four permitted categories of permitted costs. However, in early April, the SBA created a new requirement that 75% of the proceeds must be used for payroll costs. This restriction applies to forgiveness, and it also applies to the permitted use of the funds. And the regulations specifically state that not more than 25% of the loan forgiveness amount may be attributable to non-payroll costs. Accordingly, the 75% threshold does not only impact eligibility for forgiveness. Instead, using more than 25% of the proceeds for non-payroll costs could be considered an improper use of the proceeds. In paragraph 2S of the initial guidance the SBA explains that if you use funds for an unauthorized purpose, the SBA will direct you to repay those amounts. If you knowingly use those funds for an unauthorized purpose, you will be subject to additional liability, such as charges for fraud. If you look at the current loan forgiveness application, it seems to assume that the failure to meet the threshold is not intentional, and it indicates that if you use more than 25% of the proceeds on non-payroll costs, that you're simply waiving forgiveness on those amounts and not committing fraud. Now, this 25% threshold has been or will be changed by the Flexibility Act. The Flexibility Act changes that ratio to 60-40. In other words, only 60% of the proceeds need to be used on payroll costs, and 40% can be used on non-payroll costs. This should be helpful for businesses with high rent but limited number of employees. This seems like a better deal for small businesses, but we'll have to keep a close eye on it and see if any subsequent regulations come out. For example, based on the text of the Flexibility Act, Senator Marco Rubio has warned that the Treasury Department has advised him that if this law goes into effect, failure to meet the thresholds will result in zero forgiveness. Accordingly, if Mr. Rubio's statements are accurate, meeting the threshold is very, very, very important. So with that one, we'll move on to our third do or don't, and this is another don't. And that is, and this somewhat relates to what counts as a payroll cost, but it was so confusing, and so we received so many questions on it that we decided to break it into its own topic. So, and it's don't reduce your payroll costs by removing taxes imposed on an employee and required to be withheld by an employer. As noted above, the CARES Act provides that federal taxes don't count as payroll costs. The regulations state federal employment taxes imposed or withheld between February 15th, 2020 and June 30th, including the employees and employers' share of FICA and Railroad Retirement Act taxes, and income taxes required to be withheld from employees, are not payroll costs. However, when anybody pays their employees, the gross compensation paid includes amounts withheld from the employee's share of federal taxes. There was confusion as to whether that portion had to be removed when calculating payroll costs. In its frequently asked questions that Albert noted are updated by the day, the SBA confirmed that the entire gross compensation amount counts as a payroll cost. Specifically, in frequently asked question number 16, it confirmed that payroll costs are not reduced by taxes imposed on an employee and required to be withheld by the employer. And they provide an example that will help illustrate this. An employee who earned $4,000 per month in gross wages, from which $500 in federal taxes was withheld, would count as $4,000 in payroll costs. The employee would receive $3,500 and $500 would be paid to the government. Accordingly, taxes imposed on an employee and required to be withheld by an employer are payroll costs. And this interpretation clarification was welcome news to almost all recipients of loans. As a caveat, the employer side federal payroll taxes imposed on, in our example, the $4,000 in wages are excluded from payroll costs under the statute. And our final do is an important one. It is seek forgiveness for all payroll and non-payroll costs paid or incurred during the covered period. This was a big and welcome clarification issued by the SBA because the 8-week covered period was fairly small, and depending on when you got your loan, it wasn't exactly clear how you would account for costs incurred and paid within the covered period. Now, if the Flexibility Act becomes law, its impact will be less important, but it's still really critical to know what the rules are. Recently, the SBA set forth its rule on loan forgiveness, and it confirms that payroll costs paid or incurred during the covered period are eligible for forgiveness. Payroll costs are considered to be paid on the day that paychecks are distributed or the borrower originates an automatic credit transaction. Payroll costs are incurred on the day the employee's pay is earned. In other words, the day the employee works. Payroll costs incurred during the borrower's last pay period of the covered period or the alternative covered period are eligible for forgiveness if paid on or before the next regular payroll date. In other words, if your covered period was set to expire on June 30th, but your paycheck, your next payroll isn't until July 5th, the amount of money earned up to June 30th would count as payroll costs because that the amount worked, the employee would have incurred those costs during the covered period. The SBA also created an alternative payroll covered period for some borrowers with a biweekly payroll schedule. This is best explained via an example. Assuming a borrower has a biweekly payroll schedule every other week, and the covered period begins on June 1st and ends on July 26th. The first day of the borrower's first payroll cycle that starts in the covered period is June 7th. In other words, the borrower may elect an alternative payroll covered period for payroll cost purposes that start on June 7th and ends 55 days later for a total of 56 days on August 1st. Payroll costs paid during this alternative covered period are eligible for forgiveness. So that is a nice flexibility option available to those who have biweekly payrolls. As for non-payroll costs, the rules are essentially the same, but there's no alternative covered period. Non-payroll costs are eligible for forgiveness if it is paid during the covered period or incurred during the covered period and paid on or before the next regular billing date, even if the billing date is after the covered period. Again, these are usually easier explained via an illustrative example. So let's say a borrower's covered period begins on June 1st and ends on July 26th. The borrower pays its May and June electric bills during the covered period and pays its July electricity bill on August 10th, which is the next regular billing date. The borrower can seek forgiveness for its May and June electricity bills because they were paid during the covered period. In addition, the borrower can seek forgiveness for the portion of its bill through July 26th, the end of the covered period, because it was incurred during the covered period and paid on the next regular billing date. Now, I used an 8-week covered period example there because borrowers are able to retain the 8-week covered period, and it's easier to visualize. But again, the covered period has been extended, it looks like, to 24 weeks. The SBA put out an important reminder that even under this extended period, you got to make sure you do not exceed the threshold. It was 25% and is now 40%. So those are 4 do's and don'ts. I'm going to conclude this to see if everybody's been paying attention. And I'm not going to tell you whether it's a do or don't, but I'm just going to give you a factual scenario and see if this is an appropriate use of Paycheck Protection Loan funds and whether this use will be forgiven. And the hypothetical is this: if you get a Paycheck Protection Loan, should you use the proceeds to purchase yourself a Rolls-Royce, Rolex watches, jewelry, or use them to make child support payments? Obviously, no, you should not use them for this purposes. Unfortunately, this is actually a real case, and federal prosecutors have charged this individual with bank fraud. This brings us to a larger point. What happens if loan funds are misused? Is the worst possible result loan forgiveness, loss of loan forgiveness? As set forth above, if you use the funds for an unauthorized purpose, you'll be directed to repay those amounts. If you knowingly use the funds for an unauthorized purpose, you will be subject to additional liability, such as charges for fraud. In a statement, the Department of Justice has stated, "We will investigate and charge anyone who inappropriately diverts these critical funds for their own personal gain." I just thought that was a fun example, just to know that there are some really clear-cut cases, but based on the guidance that we've provided you, and you've probably learned yourselves, not a likely scenario that any of you will face. Thank you for your time. I'm going to turn this over to Albert, who will provide some tips for maximizing loan forgiveness. Thank you very much.
Thank you, Chris. Everything Chris just talked about that, the hows, the do's and don'ts about spending the money right. Everything there is dealt with by a carrot and a stick. So the stick, we'll start with the stick first. The stick is what you just mentioned. If you don't spend the money right, you do so intentionally, unintentionally, you don't follow the rules. If you don't spend the money right, the consequences are negative. Chris talked about bank fraud, losing forgiveness. Now the carrot is that if you do spend the money right, if you spend it on qualifying payroll costs, qualifying non-payroll costs, you don't go outside the lines, you spend them in the right ratio, which appears like it's heading toward 60-40, what you get, the benefit that you get, the positive reinforcement that you get, is you get loan forgiveness. This turns this great loan into an even better loan because it changes it from a loan to a grant. So if you spend the money right, the presumption is that you'll have 100% of it forgiven. So if you get $500,000 and you're careful that you spend no more than, as we anticipate, 60-40% rules met, you don't spend too much of it on non-payroll, you spend most of it on payroll costs, you dot the I's, you cross the T's, then the presumption is that you can then apply for forgiveness. The SBA has recently issued some rules to clarify that in terms of who's in charge. You send it to the lender does the first review. So the presumption is that if you do the spending right, you'll get 100% forgiveness. However, the additional kind of moving parts in this law is that unless it turns out that you have reduced and not fixed two things. You have reduced headcount during this pandemic, and you didn't bring people back, which is presumably what the primary purpose of giving you this money that could turn from a loan into a grant was for. Or if you reduced salaries, wages, of people and then didn't use this money to bump them back up. So you start out, if you spent the money right, with a premise that you are entitled to 100%, but that 100% gets reduced by two tests, what we would call a head count test. FTE test is also the same name, the FTE head count test, or a wage reduction test. They're two separate tests. So there's two ways your 100% forgiveness could be reduced to, say, 93%, 85%, 50%, whatever that is, based on these two tests. And I use the percentage because I want to highlight, but both of these tests are ratio tests. They're based on the ratio by which you did not bring back people that you had let go during this period, or the ratio by which you did not restore lost or cut wages to their levels pre-coronavirus. That gets multiplied as a numerator and denominator against 100%, and that reduces your 100% forgiveness presumption to 83, 95, 50, 20, whatever it is. Okay, so the benefit that we have pretty recently is that we now know more than we ever have about the details by which these tests are going to be run. So you've got these general premise of forgiveness. You've got the potential for reduction based on headcount, FTE cuts. You've got the potential for reduction on the payroll, wage cuts. You have a potential out if you restore those things like you're supposed to be doing with the money. So these things, we finally have some guidance as to how they will work in real life when you apply for forgiveness. So it comes down to two documents we've already mentioned so far. One is the PPP loan forgiveness. This came out on May 15th. It is an 11-page document. About 3 or 4 pages are the actual things, the form you fill out. The rest of it is definitions and guidance, which has a lot of substantive information in it. That's one. If you go to our site and look at the articles that we've written, we have on May 18th, we have an article that links to the actual application. If you want to pull it up, you can also Google it. PPP loan forgiveness application ought to do the trick. And you'll see by clicking an 11-page document. And what's nice is that we finally have the actual document. This is something you can actually have a real live practice, dress rehearsal for. The old saying is if you're going to play in a golf tournament, the great thing is to know what golf course it's at and play the actual course. So you have a chance to play the actual course here. So these pages, there's a form, there's a schedule, there's some tables. There's no substitute ahead of actually filling out and filing the application formally. There's no substitute even while you're in the spending period to start looking at this form and filling it out. So that's Form 1 that I really want you to find and have in front of you. And the other thing is what's called it's a rule. It's an interim, the formal name is quite formal and long. It's called the Interim Final Rule on SBA Loan Review Procedures and Related Borrower and Lender Responsibilities. Just go to SBA Final Rule and look for the one that was posted on May 22nd. So you got the application on May 15th, this rule on May 22nd. The rule kind of formalizes a lot of what's in the application. It doesn't change too much. So if you read the application, if you're going to read one, read the application. These came out on successive Fridays, ruined weekends for me and Chris, but they are very chock full of information. It doesn't answer every question people had about forgiveness, but it really, for the first time, gives you a form that you can kind of score at home with. And I highly encourage you to get into the weeds on these. Now, the color commentary here is that this loan forgiveness application, which finally gave some details, not all, but a lot of details on the spending stuff Chris talked about, the forgiveness stuff I'm talking about. And I have to say, most of the ties went to borrowers. These forms, for the most part, imparted good news. Where there was flexibility to be given a borrower, the application and the rules gave you that. So what Chris mentioned was broader senses of when you could spend the money, what you could spend it on, some clarity. And same with the forgiveness. You have some additional guidance here. Now, I think the one downside, if you want to call it that, to the application and then the rule, is there's a lot more complexity. It's not that it's bad, but there's some more complex situations or issues that are spelled out that start making it feel kind of like a tax return. There's some formalistic, very specific ways of dealing with stuff. So with that kind of setup, let me tell you what I think are kind of 5 do's when it comes to forgiveness. So practice filling out the forms. These are forms, they're schedules, they're tables, they're very specific. They will make you go get the information you need. They will make you look at time periods, very specific time periods. You may not realize are important specific time periods. It'll make you pull up numbers. The documentation is of course very important. You're going to, in some instances, submit some information with your loan forgiveness application, and in some instances, retain it in the case of an audit. But this is a great time to create 2 manila folders and start pulling in information and creating these forms and having that backup information. The second do ties to what Chris says. Do know that in terms of the total amount that you're seeking forgiveness, hopefully you can seek forgiveness for the entire amount that you borrowed. Now, before this Flexibility Act, there was a real concern for some folks that all their payroll costs and all their non-payroll costs, if there was any type of strict interpretation of what those are, wouldn't add up to the 2.5 times payroll they were able to borrow. But now that it appears very, very likely that 8 weeks will turn to 24 weeks, there's virtually no borrower that doesn't have essentially 2.5 months worth of payroll within a 24-week period. So that issue has kind of gone away. But the other limitation is this 75-25 rule, which may turn to, it looks like it's going to turn 60-40. So for the second do, know that you can't seek forgiveness beyond that fraction. So when it was 25%, the 75-25% rule, you can't seek forgiveness for more than 4 times the qualified non-payroll costs. Obviously, the math is different. If it turns to 60-40, you can't seek more forgiveness than would render your non-payroll costs 40% of that amount. So you have a cap there that is probably for most, in all intents and purposes, most practical purposes, the true limit for most borrowers. The next do in this subject is do learn the proper FTE calculation. Now, FTE, full-time equivalents, that's a concept that's very well known in employment law. It is something that we see in a variety of other laws. And one of the frustrations sometimes for businesses is that virtually every law that cares about FTEs has its own way of calculating FTEs. So until this application came out, there was a lot of speculation about how FTE was going to be calculated. The concept of FTEs was mentioned in the CARES Act. It was mentioned in some of the FAQs and the rules, but nobody actually came out and said, this is how we want you for CARES Act PPP purposes to calculate it. It is an FTE based on 35 hours, 40 hours. How do you treat certain situations? So here we go. We get this application, and the application lays out pretty clearly a 2-part or 2-choice option for calculating FTEs. It's simpler than the original language in the law implied that it would be. If you go get this 11-page document, you can look on page 7, for example, about a third of the way down. Page 7, about a third of the way down, is a short paragraph that talks about calculating average FTEs. There's some more discussion about FTEs on page 8. I'll find one more page number for you here as we go. But this calculation is very important, and I'll talk about kind of the options for that. And again, you can see the calculation set forth in the 11 pages. So what it basically turns on is the equivalent 40-hour employees that you have. So if you have salaried people that are full-time and they put in 40 more hours, you count them as one. But for folks who are not that, who work by the hour, who don't always get paid because they don't always work full-time, you have to look at fractions. So this application gives you kind of two choices. So what, in essence, you're to do is to take someone's hours during a given period. Because remember, this law, all these calculations and tests require you to know FTEs usually in periods of time. So I'm going to throw some of these dates out there. They're in the documents, so you don't have to write them down. But there's 4 or 5 periods that most borrowers are going to have to do this FTE calculation for. You're going to probably need to know your average number of FTEs for the period of February 15th to June 30th last year, 2019. You're probably going to need to know your average FTEs for the first 2 months of this year, January 1 to February 29th. You're probably going to need to know your average FTEs during the originally 8 weeks, but now 24-week kind of spending period. There's a period, the payroll period that includes February 15th is another period. So for all these periods of time, when you do the FTE calculation, what you're really doing is taking someone's total hours worked and paid, dividing it by the number of weeks in that period, dividing that by 40, and you get to see kind of what fraction of a 40-hour per week employee you have. And if that number is more than 1, so if someone is consistently working 45, 50 hours, when you do that math, you're going to get 1.1, 1.2, 1.3. This method makes you take anything that is greater than 1 and turn it into 1. For the people who are less than 1, 0.3, 0.5, 0.9, you get a choice. You either get to use that fraction, or you get to just say for non-full-time people, for simplicity's sake, it's 0.5. Now, this is complicated. There's a lot of pieces to that, but the idea, I believe, was to give you the benefit of 2 calculations that you could choose from to see which one was more advantageous to you. Obviously, the comparison is primarily important. So you're primarily looking at the comparison between FTEs pre-coronavirus and at the end when the after picture is taken. So if the Paycheck Protection Flexibility Act passes, the idea is anybody that was let go, cut, reduced, furloughed, laid off, as long as they're brought back by, in case of the extended period, December 31st, then all is forgiven. It's called a safe harbor. So these FTE calculations couldn't be more important. So do learn the proper FTE calculation in both options. So both options have the same treatment for full-time people. They're counted as 1. You don't get to count them as 1.3. But anyone under 1, you either count them as the fraction rounded to the nearest tenth, or 0.5 for someone who's not full-time. And that will start giving you a picture. It leads to the last two, which I'll come to in a minute. It's the safe harbor. It leads you to generally get a sense, based on an FTE calculation, how many people you're going to be short compared to your pre-coronavirus account. So the payroll that included February 15th, which has become accepted as a pre-coronavirus payroll, is if by, say, June 30th now, or December 31st, if we get extension of that, if by that period of time, in those periods compared to each other, you have brought back everybody that was let go, your FTE calculations will bear that out. So really important to know this very specific FTE calculation that is different than how the number of employees is calculated for all the other laws that we've had to calculate employees over the years, whether it's FMLA or Obamacare or the Families First Act that came out recently when it came to leaves. So similarly, because there's 2 kind of haircuts that you can get, 2 reductions the FTE reduction, and then also the wage reduction, you have to do the same thing when it comes to the wage reduction calculation. You have to learn the very specific way that this wage reduction is looking at wage reductions. It's looking at reductions of people under 100,000. It's looking at reductions that are more than 25%. There's a lot of the guidance in the 11 pages that talk about the salary and hourly wage reduction calculations. There's actually a multi-step kind of worksheet that they give you. A good place to start would be page 7 of the loan forgiveness application. So once you learn the proper FTE calculation method and your two options, once you learn the proper way of calculating your overall wage reduction calculation, that's good. Tuck those away. I've been telling clients that once you know how to do those calculations, before you jump into them, kind of flip it backwards, flip it on its head. I think it makes sense first to look at the safe harbors, because if you qualify for the safe harbors, then you don't really need to do the math because there's no point in the math. It moots out the math when it comes to the haircuts, because the whole idea, the whole benefit of qualifying for the safe harbors is so that you don't have to worry that the math on those two calculations will reduce your forgiveness from 100 to whatever, 93, 85, whatever it is. So from a strategic perspective too, if you have some flexibility where you're making decisions that will be affected by this existence of the safe harbor, for example, you can have a plan for bringing people back at a certain date, bring certain kinds of people. And these are head count tests. It doesn't have to be the same face. So there's a lot of strategic decisions, HR decisions, staffing decisions that can be made. So I highly recommend doing the safe harbor test first. So on the FTE side, what that means is the period of time we were talking about. Look at how many FTEs you had in the payroll that included February 15th. Look at what your FTE count will be if you make all the changes you're done making by whatever applicable date it is, June 30th or December 31st. And if those numbers show that whatever reductions you took during the pandemic, you have eliminated those headcount reductions, then you qualify for the safe harbor, and it doesn't matter what the math is on the FTE calculation for the haircut. And the same thing happens on the wage reduction as well. So the existence of these safe harbors are exactly how they're intended. They're meant to be a safe harbor. They exempt you from worry about a calculation that would otherwise give you a number other than 100%. So I think it's important to know that these aren't kind of ethereal, existential questions. These are very accounting-ish. A lot of accounting firms, you should check with your accounting firm or your payroll company. A lot of them are doing a great job out there offering services to help you push your numbers, get the data, and push them through calculators. I think they're quite helpful. I've seen a couple spreadsheets out there that were very useful, but it really comes down to getting acquainted with the forms, the schedules, and tables, getting all the information that needs to be had to plug into those. Understand the maximum forgiveness that you're even eligible for, learn the FTE and wage reduction calculations, or hire and hang out with people who know them already, and then zone in, see if the safe harbors apply to you, and if they do, then game over. If you spent the money right and the safe harbors apply, then you're likely to have a good chance of getting your 100% forgiveness. So this, I just want to say one more thing on forgiveness. This Paycheck Protection Flexibility Act that Chris was talking about. Again, this is breaking news. It had passed the House. It just passed the Senate last night. It's been sent to the President. As of the moment that we started this seminar, it hadn't been signed yet. The expectation is that President Trump will sign it. There was a tremendous amount of agreement in the House and Senate, so it would be a shock if the President signed it. Combined between the House and the Senate, only one person voted against it. It was a unanimous voice roll call in the Senate. So assuming that happens, there's an interesting part of this Paycheck Protection Flexibility Act that adds something that had never really shown up on our radars before. It's an additional exception. It's an additional way not to have certain headcount reductions hurt you on the forgiveness side. So these are all new. There's 2 new exceptions that allow borrowers to achieve full forgiveness. even if the full headcount isn't restored. Okay, so before we had talked about things that are mentioned, that we have already mentioned, things about if someone is asked to come back and refuses, someone who voluntarily quits, and so forth. But now we've got two more. So this new bill, if it turns into a law, will allow forgiveness, even if there's headcount reduction, if the business can show that they could not find qualified employees or were unable to restore business operations to pre-coronavirus, which is February 15th, 2020 levels, due to COVID-19 related operating restrictions. So I read to you almost verbatim. That's the issue. It's if they can't find qualified employees or they're not able to restore business levels, this is a huge out. It's vague. There's going to be a lot of debate about exactly where the contours of that are and how you qualify. Don't. Very likely to see some additional guidance. But if your business is one that is particularly susceptible to this, to a longer lag time, so you're trying to, but you can't hire people back for these reasons because of either the business operation side or because you can't find people, this allows you not to get dinged on the forgiveness. And this is an extremely significant development. So after today, go online when you get a moment, when you have a break, Google Paycheck Protection Flexibility Act. If President Trump signs it, then the stuff we've talked about today kicks in and you replace some of the things that you knew before. You replace the 75-25 and the 60-40, replace June 30th with December 31st, and you have these two things that might help. So the last of the four topics we're going to talk about today is what documents, information do we keep, retain, submit. The easy answer here is the one and only do under this section. So do curl up with page 10 of the application. So if you find this application, follow the links I mentioned. They're on our website. You can Google it. Go to page 10. Page 10 is a kind of single sheeter that breaks down in two categories the documentation information requests that you should have in front of you. So the first category is the information that you're going to need to submit with your forgiveness application. So it's as you would expect, it's the things that go towards what numbers you fill out and what lines of the application. And the second category are things you don't have to necessarily submit, but are things you should tuck away in a manila folder that shows that you have the backing for things that may be an issue if there's an audit or an SBA look at the loan. So again, not a lot of logic here, not a lot of arguing. Page 10 is page 10. And we're grateful for the specificity of the language in that. So with that, we, again, thank you for coming. We hope we've discussed this late-breaking news, which, again, is hot off the presses and could come into play and be final very shortly. We've outlined what we think are the four kind of pieces of the pie to look at for PPP. We've given you 12 do's and don'ts. And we've kind of finished this part of the program. We do know that there have been some significant number of questions coming in, so we will now turn to some of those. So one question here is, we heard that transportation is a kind of utility that is one of the non-payroll costs that is an appropriate use of PPP loans. What counts as transportation? Chris, you want to start answer, and I can chime in if I see anything to discuss.
Yeah, absolutely. Guidance as to what counts as transportation is limited. The SBA guidance we have of now on this point is limited to self-employed individuals. This guidance states that gas used for driving business vehicles is a forgivable use of loan proceeds. This suggests that gas expenses and expenses from standard mileage allowances may be permitted, but at least as far as I'm aware, we don't have definitive guidance on that point as of yet.
Great, thanks. Thanks, Chris. I agree. There's not a lot of specific detail. The thing that you read in little snippets that comes out is fuel for business vehicles. Next question. With the extension of the cover period from 8 weeks to 24 weeks, is that 24-week period firm, or can you pick a period within that time frame to set the covered period at less than 24 weeks? Chris, any thoughts?
So I believe, if I understand the question correctly, is that if you get your loan proceeds on June 1, and you are able to use up all the funds in 10 weeks, do you have to wait 24 weeks before going and applying for forgiveness? And I believe the answer is no, you don't need to wait. You're able to apply for forgiveness as soon as you have used all of the proceeds in a manner that is consistent with the program.
Yes, and I agree with that. The Flexibility Act is really about giving flexibility. So if you can't spend the money within 8 weeks for a variety of reasons, you can't ramp up quickly enough, your state hasn't opened up to the point where that money would be meaningfully deployed, it gives you more time. But I don't see it as a mandate for you not to spend it and apply for forgiveness prior to the full 24 weeks.
Yeah, for example, like if you own a restaurant or an event center, it would be physically impossible for you to actually have a full staff by June 30th. And depending on when things truly open up, you might need up until December 31st to use all of your proceeds on payroll. But I just think if you are able to get up and moving faster, that you're certainly able to do so and don't have to wait for forgiveness.
Great. Next question, and this is a question that is widely debated out there. It's, am I correct in saying that owner employees must use the smaller average of wages from 2019 to be forgiven of PPP? With a follow-up question, does it matter what percentage an owner employee that you are? So Chris, if you don't mind, let me start the answer and then you can chime in as you see fit. So this has been a subject of a ton of consternation, controversy, and debate because between the law itself, the CARES Act, and the subsequent rules and Q&A's guidance, there are a variety of terms that have come up. This owner-employee issue was raised in the PPP protection loan forgiveness application that came out on May 15th. And the discussion in that application made it clear that owner employees are to be treated differently, so differently that they're not even tabulated with non-owner employees, just what we call regular employees. They get pulled out. And the idea is that the forgiveness that you can seek for their payroll costs is limited to not what their real payroll costs were in the covered period, but what they would have been in a representative period, so 850 seconds, because this was prior to the extension, 850 seconds of 2019. The clear motivation behind pegging it to a 2019 number is the concern that if you're an owner employee, you can manipulate how much you pay yourself. And you might be tempted to take this PPP money and pay yourself more than you otherwise would, up to the cap of $100,000. And so the way to head that off is to freeze in time something that's already happened and therefore can't be changed, which is what 850 seconds of last year's pay would be. So that's fine. The confusion comes that this owner-employee phrase is new in this context, and there are other phrases that the SBA and the CARES Act have used to describe people that are in some sense owner-employees. So there's a lot of other guidance, a whole rule that talks about what limits there are on people who are self-employed, people who are self-employed and file Schedule Cs on their tax filings, people who are partners or general partners. There's even a reference to something called an active general partner. So if you take all of these uses, the interpretation is that the SBA wouldn't have used different terms if they meant the same thing. So is an owner employee different than a general partner, different than someone who's self-employed, different than someone who's an independent contractor or Schedule C filing, sole proprietor? That's not particularly clear. So what is clear, and there's some discussion about S corps and how it could be different. So what seems to me to be the safe way to look at this is if, well, number one, look for guidance that applies specifically to you. So there's guidance if you Google the FAQs and the rules. There's a rule, I believe, sometime in April that specifically referenced some pretty significant limitations on self-employed sole proprietors. And there was discussions in that rule about general partners. So if any of those descriptions clearly apply to you, then of course that kind of runs the show. If, however, you are just a shareholder and not a partnership, and you're not a sole proprietor, you didn't file Schedule C, then I think common sense should prevail. So if you own the company, I've not seen a specific percentage. That limitation that ties back to 2019 seems to be a pretty significant one. And it's pretty serious because that's actually part of the specific certification that's set forth in the loan application. So in the loan application, it specifically talks about the specific limitation when it comes to that. So it's page 4. Page 4 of the 11-page application talks about you signing below making these following representations, and you're certifying that the dollar amount for which forgiveness is requested does not exceed 8 weeks worth of 2019 compensation for any owner, employee, or self-employed individual, general partner, capped at $15,385 per individual. That's not a magic number. That's 850 seconds of $100,000. So there's that. Obviously, all the things that it's talking about in terms of the 8 weeks would be subject to change and modification if the periods get extended. But you can kind of see why there's a little bit of flux in here about who gets covered in these definitions and not. And there's some additional complexity. There's within the realm of payroll costs, there's cash compensation and non-cash compensation. So early on, there was a clear clarification that the $100,000 cap was on cash compensation. It was not for normal employees a cap that would cap what you could pay out of your loan for things like retirement contributions and other kinds of things. That is not the case for certain self-employed folks. It's meant to just replace that income. So again, look carefully at those parts of it. And if your particular structure is defined, follow those rules quite specifically. Chris, anything you want to add on that?
No, Albert, I think you covered everything and more than I was going to say.
All right, so then a couple more. We have time for a couple more. Someone asked Chris when it came to your part about payroll costs. They want a clarification on whether you said that the employer's portion of FICA is excluded from payroll costs. Apparently, we were having a little static there at that time.
Right. So the rule is that the employee side counts as payroll costs, but the employer side of payroll taxes imposed on wages is excluded from payroll costs under the statute. So the employer side is excluded. And the SBA does a fairly in-depth explanation in their frequently asked questions explaining how they came to this interpretation. But the general rule is that employer side federal taxes based on wages paid is excluded.
Great. Another question, this has to do with the wage reduction calculation. So the extent to which you're otherwise presumed 100% forgiveness would be affected in a kind of pro rata way, is that calculation a calculation that's done with an hourly pay rate for non-salaried employees, or do you use the gross amount of wages paid, actual hours, in conjunction with the hourly rate, or if the hours decline but the wage rate remains the same, how does that work? So the easy answer, of course, is there's a worksheet for that in the application that walks you through quite specifically that calculation. The short answer is it looks at the rate at which people are paid. But the specifics of it, again, there's no substitution for getting walked through quite specifically the calculation. And if you have it handy, I'll give you the page. So if you look at the bottom of page 7, into page 8, it's a pretty detailed step-by-step calculation for the hourly wage reduction haircut test. I think maybe we have time for one more question. So this is another question about utilities. So with respect to the extent of utilities, we understand things like electricity and water, but how about internet fees, even hosting costs and monthly software fees? Any words of wisdom on that, Chris?
Yeah, the regulations in the Act say that payroll costs, and I'll just read the actual text. Payroll costs include business utility payments for the distribution of electricity, gas, water, transportation, telephone, or internet access for which service began before February 15th, 2020. So in the above example, internet costs seem like they would count, but I'm not so sure about hosting costs or monthly software fees. In other words, it looks like the specific examples are not specific categories are given, not necessarily examples.
Great. I think we can actually get one more in. This one is actually interesting to me because it was a subject I talked, so I'll throw it out there and answer it pretty quickly. So how quickly would it be to justify the need for a PPP loan if your business was a business that was deemed to be an essential business and therefore continued on as normal and nobody knew what was let go during the virus? The issue is, of course, that no one can predict the future as far as this virus goes, and it's just inherently uncertain. So this, to me, really goes to the do and the don't that I mentioned when we talk about the subject of being able to justify the application and keeping of the loan. It is certainly true that there's this uncertainty about the virus. No one knows if there's second or third waves. I think particularly, I assume that if you're asking this question, you're over 2 million. I think it's incredibly important to be specific when it comes to you. It, to me, has to be granular. So rather than just general uncertainty, how does that general uncertainty affect you? Now, if you're a car manufacturer, car part manufacturer, if you're a nursing home, there are some businesses in which the general uncertainty is particularly uncertain to those particular industries, and I would cite that. I would cite it in terms of how much liquidity you have and how quickly that utility could be eaten up by sunk costs even if you have no product to get out the door. But it's got to be about the dates in question, and it's got to be about your specific business. I would be very, very specific about the conditions in your business, conditions in your bank account, conditions in your cash flow, your receivables, and your payables. So with that, we have come to 1:30. I can't thank you enough for joining us today on behalf of Chris Fultz, Og McTiernan, everybody at Tucker Ahrensberg. We appreciate the time you spent with us, and we wish you the best and continue to be safe and well.